All right, the third type of adjusting entries that we'll go through is deferred revenues. Deferred revenues occur when you have to adjust for amounts that were earned that had been collected in advance. In other words, earlier you'd gotten cash from customers, but you couldn't call it revenue at that time. You had to wait. You had to defer recording it as a revenue. And that's because of that revenue recognition. Remember, even if you've collected amounts in advance, it doesn't mean, just because you got the customer's cash doesn't mean you can record revenues. You have to have earned it. In other words, you have to have given the customer the good or the service in order for you to increase revenues. So let's go where you deferred revenues have to occur or will occur when you get a cash in advance. You'll debit cash and you will credit unearned revenue. You cannot credit revenue. So in other words, revenue is deferred until earned. The adjusting entry, though, may need to be done at the end of the accounting period. In other words, you have to look at your unearned revenue account as an accountant and see, is that credit balance the proper amount, or have we since earned some of that revenue and have to make an adjusting entry? Because you're not going to have the customer saying, hey, you've delivered the good. Make sure you adjust your liability account. That's done internally. All right, so let's go through know-it-all. Know-it-all, let's say collected $1,200 in advance from a customer on May 1. And the services, this $1,200 is to cover 4 months worth of services beginning May 1. So let's go through the entries. When you get the cash, you'll debit cash. You cannot credit revenues because at that point in time you haven't earned any of it. You owe $1,200 of services. That's a liability. So you'll be crediting unearned revenue. When you get to the end, when you get to the end of the accounting period, you have to figure out how much of that liability have we earned. Well, since it's covering 4 months, if you take 1,200 and divide it by 4, you get that you've earned 300. So you can reduce your liability by 300 and credit now revenues. So post those to your T accounts. Again, we had the 1,200 for cash. Then when we record the adjusting entry, you have the 300 there and the 300 here. The balances then would be 900 on unearned revenue. So in other words, you've collected 1,200 in advance, you've earned 300 of it, you still have yet to earn 900. So again, the financial statements, you have your revenues on your income statement. Again, revenues over here on the income statement show how much you've earned. It tells you nothing about what you've collected. The cash flows will show how much you collected, and it will say 1,200. Now I don't have that T account here, cash, but hopefully you can see that it would have been debited for that 1,200. The balance sheet explains why those are not the same, and that account being unearned revenue. It explains the timing difference between when the cash is collected. You collect the cash first and you wait and record the revenues later when you earn them.